Hey guys, I have a special guest on the show today. This is Aaron Bush with Fairway Lending. And I brought him on because I wanted to talk about this hot topic of inflation, okay? And how does inflation affect the housing market? And so we're going to, this isn't like super planned out, but I know that he's an expert in lending. And so I thought that it'd be great to, let's just have a conversation about that, okay?
Yeah, absolutely. Thanks for having me.
Yeah, yeah, of course. And okay, so what do you think? I know that you have some slides that you'd like to share with us, but tell me
Mhm.
maybe overall, how do you think inflation will affect the housing market overall to, the general buyer, like in our layman's terms?
Right, right. It's such a great question, and I'm getting this a ton. I know you are. I think to answer it, we have to put what inflation and where rates are in perspective, right? Because it's so easy to go, oh, I mean, 6 months ago we were locking rates in the high twos or low threes, and now we're approaching five. So it's very
Mhm.
easy for people to hear this, including, us in the business, and go, my God, these rates have just really increased. So, but then we need to zoom out a little bit and look at it from a historical perspective. And the way to do that is, and everybody can do this, you can go to freddiemac.com. Hopefully people have heard of Fannie Mae and Freddie Mac. And if you haven't, they are government chartered entities that were started in like the 60s to help spur homeownership, because the government recognized that, hey, in order to spur the economy, we need people to buy houses. So then, starting in the early 70s, Freddie Mac started tracking mortgage rates. And so you can go back and you can look at the historicals, and they start out at, reasonable, what historically speaking are reasonable rates, like 7 or 8%. We hear that and we go, oh my God, that's high. But at the time, right, that was pretty low. And then they start to go up. And then we see the early 80s where rates were at like 18%, which is
Yeah.
just insane. That's credit card level interest rates, right? That's just wild.
Mm.
And and then they start to drop back down. But what's interesting to note is they don't hit 5% until the early 2000s. So for over 30 years, rates were well above 5%. And I was in the business. I got in the business in the late 90s. And so when I was first in my first like 5 years in the business, we did a lot of refinances because
Yeah.
so many people were at 7, 8, 9, 10%. And all of a sudden now we're at 5 or 6%. It's like, this is amazing. I mean, everybody
Yeah.
was so excited about it.
My
And
first
then,
home, my first home was 8.25%. So when it went down to when we refinanced at 6.25, I thought, whoa, this is freaking
right,
amazing.
exactly. And so we've been really spoiled over the last few years with these. I mean, we shouldn't say historical lows. Let's put it in context. It was artificially low rates. And the
Okay.
reason these rates were so low is because the Fed pumped in money into mortgage bonds, which drove rates down. And that's really what spurred on this really strong economic recovery post pandemic, right?
Yeah.
So now
Now
the
they're
Fed's in
wanting
a
to sell
predicament.
them, right? And that's creating
Exactly.
higher interest rates, correct?
Exactly. So now the Fed has to back up on their, this thing that's happened where they've created these really low rates, and they're going, we got to get back into a little bit more historically reasonable rates. So really, that's the crux of what we're dealing with at the moment. So, and that's inflation, because now the Fed is raising rates. They don't directly impact the mortgage market per se, but by raising rates and by getting out of buying mortgage bonds, they're causing mortgage rates to increase.
Yes, yes. Okay. So share some of your slides with us.
Yeah.
Let's
Okay.
get
So
started in this.
it's so good to see this in the historical terms, because what tends to happen is we think, and again, you and I in the industry, and average folks at home that really don't monitor this stuff, we just go, rising rates means higher costs, which means maybe I can't buy a house, right? So what we have to do is really understand what the Fed is doing and what's happened historically. So if we go back and we look at some of the Fed chairs here, we have some people will recognize these names like Alan Greenspan, Burns, Volcker. We're going back, like 30 years or something, to our current Fed chairman, Chairman Powell. And so what happens is we see these inflation rates. You'll see that here. And then we'll see where mortgage rates were. And again, look at this in context, guys. I mean, mortgage rates under these chairmen, 12 to 18%, under Alan Greenspan, 7 to 8.5%. And then where the federal funds rate was at that time. So again, we're at just anomaly lows, 0 to 3%. And then what happens, to inflation? And what ultimately the Fed is doing is they're raising these federal funds rates. And what happens to mortgage rates? Well, mortgage rates are, historically have, in some cases, have actually gone down, right? So when the Fed starts raising rates, mortgage rates can actually drop, which is really kind of crazy. Now, it won't happen immediately because the market has to react. But why do mortgage rates fall after the Fed raises rates? Well, it's because of this really nasty word. I'm sorry, I have to bring it up: recession. Right?
Okay.
No, when we hear the media and the media talks about, oh, we're in a recession, it's such a negative context. And, understandably so, because sometimes in a recession, people, their wages may go down or something like that. But when you're in an inflationary period, wages actually go up. So at least
Yes.
initially, we could see wages go up. And even though rates are going up, affordability is still there because a lot of people are seeing raises because cost of living raises. So what happens if we get into a recession? Will the economy slow? Well, that's the point of a recession. Yes, the economy can slow down a little bit, but what happens to housing? I think that's a really important thing. So let's go down here. Sorry, I have a lot of slides here. This is a good one, actually. I'm going to pause on mortgage rates and recession. So if we get into a recession, almost every time mortgage rates drop. So we could see this rates rise to 5. I mean, God, we could hit 6%. That's possible. But then if we hit a recessionary period, rates will drop. And then that will create, a little bit better buying market. But the important thing is to look at the historicals on what happens to housing during recessions. Well, housing stays strong. And that's not Dana and I's hope. That's historical proof, right? I mean, housing stays strong. It's one of the few assets that you can buy that can stay strong regardless of what happens in the
Okay, but
economy.
what about, so what most people are going to think is the last big recession of 2007, 8,
Right.
and we saw that housing was, we would say it wasn't strong in that time. So tell me a little
Yeah.
bit more of what you mean by that.
Yeah, that's a good point to bring up because a lot of people think about that. I mean, you may have owned homes during that time. I mean, I did, and the value of, at least we're in Dallas Fort Worth area, at least for the most part, our housing prices and values didn't drop very much. They kind
Yeah,
of
not
plateaued.
here. I mean, they did a
Right,
little bit in
right,
many neighborhoods, not all neighborhoods, but yeah,
right,
it was
right.
more mild here for Texas.
So we were somewhat insulated in that, but many people across the nation really experienced severe housing decreases in value. But that was really a different situation because our housing market was propped up by bad loans.
Right,
And
right.
bad loans at the time meant, I mean, literally, I was in the business during this time, so I can say this
Mhm.
with,
I was
my
too. Yeah.
own, yeah. So we saw loan applications literally had a name and a social security number. That was it.
Oh, wait. I was among the people who should not have gotten a loan. We were like, our first loan was when I was 20, and then we got 3 rental properties right after that. And we were like, I'm like 22, 24 years old. I don't know what the heck I'm doing. And they're like, yeah, just stated income, whatever, just sign the
Right,
paperwork. And they're giving
right,
us money at closing. There's a reason 2008
right,
happened.
right. Yeah, exactly. I mean, it
For
was,
people like
it,
me.
well, and not just you, but I mean, everybody was buying houses. You didn't want to miss out on an opportunity. You had your friends, your cousins, every single family member all buying houses. And then they were taking equity out of houses and then buying boats. Like everybody was just
Yeah.
spending money like it just would never end. And so ultimately, what we learned by that is that wasn't a good thing, and we shouldn't do that. So the government came out, they put in some requirements and restrictions with mortgage companies and said, hey, you know what? If you're going to give a loan, you need to be able to verify that these people have the ability to repay. That's a
Right.
big,
They're strict too. They're
yeah,
they're pretty strict.
Yeah, so it all follows under these QM rules, which is called qualified mortgage. I won't go into all the jargon, but bottom line is we as lenders have to validate that people actually have the ability to repay the loan. So housing prices have continued to gone up. We have a really strong housing market, but the fundamental difference is we have people that have the ability to repay mortgages. Whereas in '07 and '08, people could not repay mortgages. So when defaults happened, we saw excess supply in the market. And when we have excess supply, housing prices drop.
Okay,
and
let's
that's what
talk
happened.
about, okay, that makes perfect sense. Let's talk about the supply relative in history.
Right. Hey, you killed it because that was my next slide.
Right.
So we have, I mean, we have a record low inventory, right? So we have extremely low inventory, and we have big demand because people have realized during the pandemic and post-pandemic that, hey, I can work remote, I can move anywhere, or I don't like where I live, I want to go move somewhere else. And so there's so much demand across the nation that people are moving like crazy, and there's so much demand, but we have very limited supply. And then this is a good slide to look at. We have the number of households looking to buy, or number of households in the US, 129 million. And we have, if we compare that to 2007, right, we have more households looking to buy, but we have 3 million fewer homes. So we got more people buying and less homes. So that's what creates this inequality in the market, because you have more buyers than sellers. And so sellers rule.
So let's talk about, this in context with a recession. I mean, I thought we were talking about inflation, but this is going to recession instead.
Yeah.
But let's talk about that, because if there's still a supply demand, ultimately, it's just hard for me to see that house prices are going to crash. I mean, I'd like to see them pull back. I'd like to see a more balanced market personally, but it's really just hard to see when is it going to end? I guess, okay, so I'm just talking out loud. I guess I could see where if we go into a recession, that employers, then ultimately people stop purchasing, like, say, they go out to the restaurant, they're going to start pulling back on some of their spending habits, right?
Mm-hmm.
Which in return creates less product that businesses are selling or whatever, right? All that being said, eventually people start getting laid off, right? In a recession, and that could pull back some of that demand and pull back. I still can't imagine a crash like 2008. But do you think that could have an effect if we went into a recession in that regard? Not that I explained it very well, but you know what I mean.
No, I think you did. I mean, and that's the reality. I mean, I don't want to gloss over the word recession, because if that happens, I mean, some people might be impacted by it. But the reality is that even if people are impacted by it, people still need housing. So you're still going to pay rent, and rents are going up. You're still, you still have to live somewhere. So what do people do? Okay, maybe I don't buy the $500,000 house. Maybe I have to buy the 350 house, because we're down to one income in the household, but people still have to buy houses. So that's why housing typically stays strong in a recession. And I know I really jumped from inflation to recession, but you really can't talk about one without the other. That's because true. Inflation leads to recession. But again, if you look at the historicals, mortgage rates tend to drop in a recession, which is going to create a little bit more affordability. So it's always the folks that get caught in the in-between where it can kind of struggle, because like, oh, I just left my job and we hit this recession, now I'm waiting for mortgage rates to drop. But it happens fairly quickly. So these are things that, at the end of the day, I agree with you. I don't think we're going to see the kind of housing decline that we saw in '07 and '08, because that was just unprecedented. So I don't think we're going to see that. We could see a little bit of the housing market softening a little bit. But like you say, that wouldn't be the worst thing in the world, because we're seeing rapid appreciation that probably isn't sustainable year over year. I mean, housing going up 20 to 30% year over year is just not sustainable. It's not. So what we want to get back to is normal appreciation. What
Right.
would you say that is? What, 3 to 5% is just kind of
Yes.
normal?
4% is
And
that.
so
Yeah.
yeah, so I think all of, and that's ultimately what the Fed is after by raising rates and by, you know, trying to handle this inflation, is they're trying to bring things in check. They want to push some people out of the market. They really do. They want to go, hey, if you've been on the fence and you don't need to move, don't. Now's
Mhm.
not the
Yeah.
time. But if you need to move, or you've got a job change or something like that, or whatever, it's still a fantastic time, especially when you zoom out and you look at the historicals of rates.
Yes.
A 5% rate is not bad. And then if we hit the potential recession, then you may have an opportunity to refinance in a year. And then that
Right.
becomes even more affordable. So
Right. Okay, very good. Are there any other sides you want to share?
no, that's kind of, there's so much more here, but I don't want to get into, too much, because it just gets so complicated. But yeah, I think that's the kind of the bulk of it. So we'll stop there.